What's up, traders? Let's speak about the ICI strategy. So let's first start by defining how the strategy works. So how does the ICI strategy actually work? Now, the first thing you need to realize is that for this strategy, what you need to know is to identify when the market has created an impulse. And that is very simple, actually. Identifying when the market has created an impulse is a very simple thing to do. You just need to see a clear push to the upside that basically breaks above a structure level. So let's simplify the model. We have a push to the upside, we have a push to the downside. The market breaks above this high. At this point, this is by definition an impulse in the market, meaning the market has just confirmed that it is now in an uptrend. So basically it has created a higher high, and after a higher high, what you expect is obviously a higher low. Now, most of the times, we already spoke about this, the market will go and it will retest exactly the previous resistance, now turn support. We already spoke about this. Most of the times the market will go to retest exactly this area, which is the previous resistance, now turn support. However, this doesn't always happen. As you guys know, trading is a game of probabilities. So we know that we have a higher probabilities for this to happen, but many times the market will not make it all the way there, and it will just start the impulse from the middle of the push to all the way here. So what is the rule that we need to follow for the ICI strategy? Let's start by defining the rules. Rule number one, we need to have an impulse. Very clear, we need to have an impulse. So basically it means that we need to have a break of structure, either to the upside or to the downside. So basically the market needs to create either a higher high, so a high that is above this high here, or the same exact thing, the market needs to create a low that is lower than the previous low. So either a higher high or a higher low. So we need to have a break of structure. Then we need to have another rule, which is we need to have at least a retracement to the 382 Fibonacci. At least, the minimum is 382. So we need to have a retracement to at least the 382 Fibonacci. And how you're supposed to take this Fibonacci is from this low to this high. So basically, by taking your Fibonacci from the low to the high and waiting for a retracement at least to the 382, you will have very high probabilities for the next push to the upside. We want to see, you cannot go long until the market has hit the 382. If the market on the 4-hour time frame starts shifting bullish, so all the indicators starts pushing to the upside, price action is to the upside, and you find a valid entry in the 4 hours, you cannot take it. You cannot take the entry until the market has hit the 382. After the market has hit the 382, and all of this we are talking about it both on the daily and on the weekly time frame, then you can be looking for entries on the 4 hours. So these are basically the two rules, and then obviously the third rule is exactly as for all the other strategies. We need a valid entry on the 4-hour time frame. Very simple. We need a valid entry on the 4-hour time frame. So the rules are pretty simple. We need to have an impulse to the upside, we need to have a retracement, and we need to have one of our valid entries. Now, obviously, if we're looking at this pattern on the daily time frame, we also need to have the weekly time frame that is supporting our view on this pair. That is what we need. We need the daily time frame, the weekly time frame, to be basically supportive of this push. We want to see the weekly time frame that is bullish, because then we have even higher probabilities that this push to the upside will happen. And the same thing for a market that is trending down. Now, where will be the best probabilities for the setup? Obviously, if you have a push to the upside, the retracement is all the way down to the previous resistance, now turn support, and the weekly time frame is bullish, because in that way you have a very high probabilities that this push will happen, and on the 4-hour time frame you will be ready to take one of our valid entries. So we will be waiting for indicators to break to the upside, be in a bullish environment, and look for one of our price action entries. So basically, one of our price action entries, I will recap them again, either the previous resistance, previous support, now turn resistance, using obviously our strong numbers around this area. You get any kind of our pattern, so you get, for example, an M pattern, or in this case, if you're looking to short, you will look for a W pattern, or you can get the break of a trend line. We have a counter trend line to the upside, and at some point the trend line breaks. On the retest, again, you will be looking to short, and on both these cases, obviously, you will be using our strong numbers. Very simple. You always use our strong numbers, and you use the exact same patterns that we always use. So let's go with some live examples of the ICI strategy on the daily time frame. The daily time frame is the time frame that has the most probabilities of showing valid setups for the ICI strategy. The weekly time frame is a little bit obviously more rare, but the moves are extremely big on the weekly time frame. So in this first session, we will be looking at how you're supposed to use the strategy on the daily time frame and how to take advantage of it on the daily time frame. And then on the next session, we will be looking on how you're supposed to take advantage on it on the weekly time frame. So in this case, we will be speaking about daily. In the next session, on weekly. So let's move and see how many, just look at the price and see how many times we see a clear impulse in the price. And you can immediately see that clear impulses, you have it here, nice impulse to the downside, retracement. You have it here, nice impulse to the upside, retracement. Again, you have it here, nice impulse to the upside, retracement. You have it here, nice impulse to the upside, retracement. And you have it here, nice impulse to the downside, retracement. A bullish ICI strategy, bearish ICI, bullish ICI, bullish ICI, bearish ICI. Let's see how you were supposed to trade these particular patterns. So let's go back in time by using our reply tool, and let's see exactly what kind of price action you're getting on the 4-hour time frame, because you already know that on the daily you will basically be looking for longs. You already know that anyway. Let's first do something. We don't need indicators. Let's first do something. Let's go completely back in time. Perfect. So we will be doing it in a much more detailed way. So as you can see here, we clearly had an impulse to the upside. How do I know that we had an impulse to the upside? Very simply, because the market started here, and this high is well above this high here, and this was the previous high because the market had hit this area, went to the downside, broke above the high. Very simple concept. So on the daily, we are completely in a bullish market. Now look at the weekly time frame. We need to see also the weekly time frame in a bullish scenario, because if the weekly time frame is bearish, we cannot take the trade, as we already said. But as you can see, the weekly time frame is completely bullish. Everything is pushing to the upside. So perfect. We don't have any signs of basically very strong resistance on the weekly time frame. Everything seems bullish and the market is pushing. Perfect. So we have our impulse on the daily time frame, so rule number 1 is satisfied. At this point, the second rule is that we need at least a 382 retracement. So what are we supposed to do? Very simply, what we are supposed to do is take our Fibonacci from this low to this high. Why are we supposed to take our Fibonacci from this low to this high? The answer is pretty simple. We have to do this because we already said that we want to see a push at least to the 382. And what this means is that we first need to see the at least one daily candle tap the 382 before we can be looking for entries. So as you can see, the next candle taps much more than the 382. It goes all the way down to the 61.8. At this point, we can go on the 4-hour time frame and we can look for a valid entry, because at this point we are ready to long this pair. So let's bring our indicators and let's see what kind of price action we're getting. Now at the moment, as you can see, price action is quite, the environment is almost completely bullish. MACD above the 0. There is distance between the EMAs, and the 10 EMA is still above the 20. However, the market is below it. But this means that overall this is only a retracement, and the market is supposed to continue the push to the upside, but we still don't have a valid entry. So at the moment what we have is a nice W formation. The market goes down, up, down, up. We are expecting the market to go to the neckline. Now the retest of the neckline, in other words, is previous resistance turns support. So obviously we will have a valid entry if the market will go to this level. So let's see when the market starts the push to the downside. Okay, it seems we are not getting the retracement. Okay, we kind of broke the low, so we can expect the next candle to push to here. So what you're supposed to do at the moment is check what kind of, you don't need indicators anymore. You know that you are in a bullish market. Perfect. You don't really need the Fibonacci anymore. Perfect. At this point, you need to look to this neckline and see which strong number you see around this area. And you immediately recognize that you have the 50-35 area here. As you can see, we are in the 50-35 area. The high of this neckline, we can just identify it by putting a horizontal ray. So we want to long in between the 50 and 35. In this case, we will long exactly a couple pips above the structure level, because that is what makes the most sense. Now our stop loss can be just below this low. We already spoke about this. You can just take your stop loss below this low and you will be perfectly fine. So basically protected by structure. You know that the market is supposed to end up inside of this box, and if you put your is basically the market is supposed to be stopped by this box, by these numbers. If you take your stop loss below this low, you will be also protected by structure. Now if we take our Fibonacci from this low all the way to the high, let's see if we get at least a 1, 2, 3, and we get at least a 1, 2, 3. Now why did I take my Fibonacci exactly in that way? The simple answer for it is that if we now expect a push to the upside for the market, how do we take our target? Very simple. You need to take your Fibonacci on this push to the downside. So basically from this high here to this low here. That is how you're supposed to take your Fibonacci to have target 1 and target 2. You already spoke about this in the introduction section. So our take profit will be at the first strong number below the minus 27. Now if you look at the price, minus 27 is 1.349695. So the first strong number below is obviously 1.3480. Very simple. So going on the 4-hour time frame, let's see if the market hits our entry. Okay, the market just hit our entry, and at the moment we got a rejection. We still can't go risk-free. If now the market will break above this level, then we can go risk-free. Okay, now we can go risk-free on this trade, because basically now the market is supposed to be stopped by this area here. Perfect. Okay, at the moment we are completely risk-free on the trade, and take profit gets hit. That is exactly how you're supposed to apply the ICI strategy. Look for an impulse on the daily time frame. Look for an impulse on a daily time frame, so the market needs to have created a higher high or a higher low or a lower low. Then you need to see a retracement at least to the 382 fib taken on the impulse leg, and then you just drop on the 4-hour time frame, wait to be in a bullish environment, and take your trade according to structure in the market. So in this particular case, previous resistance turns support. Very simple. Let's keep going with the next example. So the next example is right here. The next impulse to the downside was extremely strong. You can see that from this high to this low, the market went in an extremely impulsive way to the downside. So what we then expected was obviously a retracement to at least the 32 before we can be looking for shorts. So let's see what happens. Let's take our Fibonacci from the high to the low, and let's see if the market actually made it to the 382. Now the market has just made it to the 382. So at this point, what we can do is basically go on the 4-hour time frame. We already know that the weekly will be bearish because we have had this huge push to the downside. So obviously we are expecting more continuation to the downside. Let's go on the 4-hour time frame and let's see if we can get any kind of valid entry. Let's bring our indicators and let's see in what kind of environment we are in. As you can see, we are in a bullish environment. MACD is above the 0 and MACD is above the 0 and EMAs are pushing to the upside. 10 is above the 20 and there is distance between them. So we can't take a short yet. So this is the moment at which the market shifted its momentum. MACD went below the 0, EMA is cut for short. Perfect. What we are expecting now and waiting for before we can take an entry is a retracement on this move. So basically we want to see the market get to a little bit higher so that we can execute our trade, because obviously we will not be shorting from the lows. We don't have good risk to reward. It's basically the worst thing you can possibly do. It's better to miss the trade rather than basically short the lows. So let's wait and see if the market, when the market will start a retracement, if it will. So the market has clearly started a retracement to the downside. We can take our Fibonacci from the high to the low, and you can immediately recognize something. You have clear structure around this area. As you can see, just simply looking left, you have clear resistance here. The market again comes from below, and you expect to have strong resistance here. And also, we have this trend line. So we're expecting the market to go a little bit higher, retesting the trend line, retest the structure, and fill in our order that we are about to place, and we are perfectly set on this trade. Now we already know that everything is bearish, so we don't need our indicators anymore. Now if I am to ask you where will be the target, it's very simple. You don't need to go back on the daily time frame. If you go on the daily, you already know that this will be the previous leg. So you just need to take your Fibonacci from the high to the low. It's the exact same thing that you would have done on the daily time frame. That leg is obviously the same leg. So this will be the target above the first strong number, above the minus 27 from the previous leg on the daily time frame. And I will now show you also that there is an exception to this rule, particularly for these setups. Now our order obviously will be above. Now above where? Not the 20, we know that it has to be inside of here. So our order will be at 80. Our stop loss, we know that we have resistance here. If we take a stop loss, we don't even need to take it this high. We can just take our Fibonacci from the high to the low. Let's precise our box with 80.95. So we know that our stop loss needs to be above this level, and our entry will be 80. Our take profit, I will now show you exactly why it's not here, but it's lower. And let's first talk about the stop loss. If you put your stop loss here, it's already way enough. Why do I say it's already way enough? Because look, it is protected by the trend line, it is protected by the structure, it is protected by the 61.8. It will be perfectly fine. If the market will go all the way up here, then this setup has clearly failed. The market has broken the trend line to the upside and structure is now bullish. So a stop loss here is perfectly fine. So this will be our setup. Let's see if the market goes to this area again before starting the push to the downside. Perfect, we got failed, and it seems the market has now started a new impulse to the downside. Now let me tell you why in this particular case, which is the only case in which for the ICI strategy the take profit is not basically determined by taking this leg, but it will be determined taking the impulse leg. So every time that you're taking an entry and the Fibonacci level that the market is rejecting is basically the basically the 382 Fibonacci, then you can take your entry, you can basically take your take profit at the first strong number above the -27 of the impulse leg. Why do I say this? Because if the market stops at the 382 of the impulse leg, it means the market is in a very strong impulsive move. So what does it mean? It means that we can aim for a lower take profit, and the lower take profit will be the -27 of this Fibonacci here. So Fibonacci taken on the impulse leg, which in this case will be here. Now if you look at the price in this particular case, the price of the -27 will be 1.3052. So the first strong number above is obviously 80. So our take profit will be around the 80. Let's go back on the 4 hours, and as you can see, our entry worked perfectly and our take profit hit. And this is a perfect example again of the ICI strategy in action. And we have a nice 1 to 4, and you can see how our strong numbers are holding the price perfectly. So let's go back on the daily and let's look for another example. So as you can see here, we have a clear example of the ICI strategy in action. You have the market creating a nice impulse to the upside, creating a high that is higher than this high. So by definition, a higher high. So now you do have an impulsive basically movement in the market. So let's actually go back to the basic and let's look. Now we have our impulse to the upside. Perfect. We know that the market has created a nice impulse. We know that we need to have at least a 382 retracement before we can be looking for longs. So let's take our Fibonacci from the low to the high, and let's wait until the market hits at least the 382. Perfect. The market has hit the 382 and also has exceeded it. So let's go now on the 4-hour time frame and let's bring in indicators and wait for the environment of the market to be bullish again. The environment is bearish all the time. You can see here clearly we never broke to the upside. Perfect. Now is the first time we break to the upside. Now the environment is bullish. Perfect. We don't need the indicators anymore. Now that we know that the environment is bullish, we can be looking for an entry. Now how you're supposed to be looking for this entry? Very simply by looking at structure. Where does the previous resistance turn support? Exactly here. Perfect. What you're supposed to do is to identify which price it is. And as you can see, it is 50.35. That is the area of price where you find this resistance here, now turn support. So what you will do, you will take your entry from the high. You can just identify by putting array here. Your entry will be at the high. Your stop loss needs to be below this box. How much below? We can just take our Fibonacci from the low to the high, and if you take your stop loss here, so basically a little bit below the 61.8, you will be perfectly fine. Also because your structure, basically your stop loss will be protected by this trend line. So basically if the market breaks and goes all the way to your stop loss, then it means that the setup has failed. So what about the take profit? In this particular case, since we see that the market, if we take the impulse, has went lower than the 382, to basically find our take profit, we need to take our Fibonacci on this retracement leg, as in the normal case. The only case in which you need to take it on the impulse is if the market stops at the 382. So the first strong number below the -27 will be 1.3520. Let's go on the 4-hour time frame and let's see if our order gets triggered. So as you can see, our order didn't get triggered. We never got filled in this trade, and obviously at this moment you can just delete your order because the market did not fill it. And at this point we are not interested in the trade anymore. The market has almost made it to the high. If the market will go to the downside from here, it means that the market has currently failed to continue the impulse to the upside, so we cannot take the trade. And this setup was a no trade. So let's look at what is the next example of the ICI strategy in action. So the next example will be this one here. Very simple. Boom. The market created a very nice impulsive move to the upside, so we can now be looking for the retracement before taking the trade to the upside. You have a high that is higher than the previous high, so now you're expecting a push at least to the 382 before you can take this trade. So let's take our Fibonacci from the low to the high, and we are expecting a retracement at least to the 382. So let's wait and see what will happen. Perfect. The market has now almost hit the 382. Okay, now it has hit the 382. So let's go on the 4-hour time frame and let's see in what kind of environment we are currently in. Now we are in a bullish environment according to MACD, but we are below the EMAs. So let's see if we will get an entry. No, the market never succeeded in breaking the high. Obviously, if the market had succeeded, then on the retracement we would have been looking to take this long, but the market kept pushing to the downside. Now also the MACD is now in a bearish environment, so we need to wait. Now at the moment everything has shifted to the upside. We are now in a bullish environment. So what you're supposed to do is look inside of this area, identify your 50-35 because this is the structure level, and you can take your long from this area. Your stop loss just a few pips below the box, because in this case the low is here. So if you put your stop loss here, it's already protected by the low. Now according take profit rules, very simple, always the same rules. You take your Fibonacci now on the previous daily leg, and your take profit will be just few pips below. Sorry guys. Your take profit will be just few pips below the -27. Very simple. Let's see. We are getting more than 1 to 3. Let's see if the market goes and hits our entry. So as you can see, we had a news candle here. This was obviously news. So there are two ways to go for this. You can either take the risk and wait for and basically keep your order open, or you can close the pending order. So don't put the pending order and wait to see what kind of news you get. And if the market starts to push to the downside, then just put a buy stop order and you will basically be immediately in profit if the news is faded. But the best way is basically to not trade news. It's always a good idea not to trade news, because it's like the market will be completely crazy and volatile. Now in this particular situation, what we're supposed to do is consider the fact, especially when you're backtesting, you're supposed to consider the worst case scenario. So you're supposed to consider the fact that you did keep the order and the trade was lost. Perfect. So we have two winners in this time lapse. We have two winners, one for a 1 to 3, one for a 1 to 4.8, and one loss for obviously -1%. So we are way in profit. Okay, the next example that we will consider, and then I think the concept is pretty clear, is we will consider another example of the ICI strategy. Here we go. The market created a nice low here, so basically a low that is lower than this low here. And what we're expecting now and waiting for is a retracement at least to the 382. So let's take our Fibonacci from the high to the low, and we are expecting a retracement at least to the 382. Let's see when we get it. Perfect. Now we got the retracement that leads to the 382. What is the next step? You need to go on the 4 hours and see what kind of price action you're getting on the 4-hour time frame. Put your indicators and see what kind of environment you're in. And as you can see, you are clearly in a bullish environment. So we need to wait and see a shift in momentum. Now, as you can see, the market never really shifted to the downside. The next candle, and it was news, went straight to the downside, and then and only then we had a shift in momentum. So in this particular case, this is a no trade. So in this time period, we had 2 wins, one loss. Overall, in these 3 trades, you made 6.8% if you were risking 1%, with only 3 trades on only 1 pair in only this small amount of period. So you can immediately understand how powerful the strategy is, also taking into consideration that you had a lot of consolidation during this period.